You can see how important it is by this chart that you should have seen before, which is the chart of the NASDAQ versus our global macro investor total liquidity. This is the total liquidity around the world. That's government liquidity, central bank liquidity, and private sector M2 and other measures. So it's the total amount of money printed by the system. And what happens is the NASDAQ is 97.5% correlated to it. That's incredible. The other extra bit that's not correlated that you're seeing now is the secular growth in technology. Because technology is a secular trend, because tomorrow is more digital than today. And obviously, Bitcoin, massively driven by total liquidity.
Hey guys, welcome to Everyday Finance. Raoul Pal continues to engage with the most urgent and influential themes shaping the global financial landscape, offering insights that go far beyond surface-level analysis. In a world defined by rapid change, shifting liquidity, and macro uncertainty, Pal serves as a guide for investors trying to make sense of what's next. From the evolving role of central banks and the future of interest rates, to the rise of digital assets, artificial intelligence, and de-dollarization, he breaks down the trends that are quietly reshaping everything from capital markets to geopolitical dynamics. What sets Pal apart is his ability to connect the dots between complex economic forces and real-world investment opportunities. Whether it's how a shift in global liquidity cycles could supercharge crypto adoption, or why institutional capital is quietly positioning ahead of the next macro pivot, his perspective offers a strategic edge. For those looking not just to react, but to anticipate, staying tuned to Pal's insights could mean the difference between being caught off guard or being perfectly positioned for what's coming.
Firstly, I've said this before to you all, it's all about demographics. Remember that magic formula that I've talked about in the past where GDP growth equals population growth plus productivity growth plus debt growth. Okay, got that? Well, this is the important bit. The labor force participation rate in black here has been falling for a couple of decades. That is because the population is beginning to age, and so less people are in the workforce. Now, you can see in pink, it's the births-deaths rate that is actually driving this. So as population growth has been slowing, the workforce slows over time as people get older. Okay, so that's pretty clear. An old population, however, because of the magic formula, less people in the workforce means less GDP. So trend rate of GDP has been slowing. So the economy's been slowing over time. This chart is a chart you'll never see anywhere else, and I think it's the single most important chart in all of global macro. So what is it? It's that same labor force participation rate, but this time it's against US government debt as a percentage of GDP. Now it's inverted here, and what it basically tells you is that as the labor force declines in size, or percentage of people involved in the labor force, the government takes on more debt to offset the growth. This is what it's all about. This is the big economic mess we're in. It's a mess created by demographics that I've talked about before. This chart is incredibly important. Now, look at the little divergence recently where government debt has been growing, but the labor force participation rate hasn't. That's the recent influx in immigration in the United States over the last 2 years, where some 6 million people or so have immigrated into the US, and that has kept the labor force participation rate higher, offsetting the retirees. But that's unlikely to continue, particularly with the new government. So what we'll see is the labor force participation rate decline and government debts keep growing. Okay, so we've got all of these massive debts. I've talked to you about the Everything Code. The Everything Code is the servicing of these debts by using liquidity. So liquidity is the debasement of currency. To service these debts, they print more money to service them. It's as simple as that. That is the game we're in. That is the Everything Code game. Let's talk about liquidity, because I think you've heard me talk about this before. It is super important. Liquidity keeps growing. That's the debasement of currency. It's growing at 8% a year. That means the value of scarce assets, S&P 500, real estate, gold, should grow at about 8% a year just because the currency's been devalued. Now there's another maybe 3% inflation rate to add to this, so 11% is your hurdle for your future self not to be getting any poorer, and most assets just don't do it. But you can see how important it is by this chart that you should have seen before, which is the chart of the NASDAQ versus our global macro investor total liquidity. This is the total liquidity around the world. That's government liquidity, central bank liquidity, and private sector M2 and other measures. So it's the total amount of money printed by the system. And what happens is the NASDAQ is 97.5% correlated to it. That's incredible. The other extra bit that's not correlated that you're seeing now is the secular growth in technology. Because technology is a secular trend, because tomorrow is more digital than today. And obviously, Bitcoin, massively driven by total liquidity. This time it's about 87.5% correlated. Reason being, there's a faster adoption curve, exponential growth that happens in Bitcoin or all cryptocurrencies. So that's what lowers the correlation, is in fact the outperformance. But anyway, liquidity drives everything. Now, since 2008, everything has become cyclical, because in 2008, every central bank around the world reset interest rates to zero. It was like a debt jubilee. You don't have to pay your interest, so the world could kind of recover from the debt blow-up of 2008. And for about 10 years, we had zero interest rates. And what the governments did is they reset all of their debts to between 3 and 5 years. That cycle has created a perfectly cyclical business cycle. The ISM, the Institute of Supply Managers survey, what we've got here is in black is the current cycle, which is it's currently at its lows, but the forward-looking is actually just the previous cycle moved forwards and inverted, because it keeps repeating the same cycle. So that same cycle is repeatable and understandable and forecastable. Sure, the wiggles may change, the direction will be right. And it's driven by this. This is the distribution of debt in the United States. If you look at the first two boxes, well, that's what 72% of the entire debt structure is 1 to 5 years, which is what I talked about before. This is what's causing the cyclicality that you see in the economy and these 4-year cycles.
Anthony Scaramucci couldn't contain his enthusiasm as Philip Lafont, founder of the $15 billion tech-focused hedge fund Coatue Management, publicly warmed up to Bitcoin during Coinbase's State of Crypto Summit. For Scaramucci, this marked a major turning point, one more sign that Bitcoin is finally cementing its place as a mainstream asset. He hailed Lafont's shift as validation that Bitcoin is the greatest generational investment opportunity, especially now that its volatility has cooled and institutional acceptance is accelerating. Lafont, who previously stayed on the sidelines due to crypto's price swings, admitted he was late to the game, but now sees Bitcoin as a legitimate hedge against inflation and a strategic portfolio asset. He recommends a modest 3 to 4% allocation to balance exposure with emotional comfort, acknowledging the pain of having missed the earlier upside. Scaramucci, however, says it's not too late. He describes 3 types of clients: die-hard believers who follow his guidance without hesitation, regretful latecomers trying to catch up, and the remaining skeptics still paralyzed by fear. For Scaramucci, the message is clear. Bitcoin's story is far from over. He remains bullish, forecasting a potential surge to $500,000, fueled by reckless government spending and growing distrust in fiat systems. His call to action is simple. The window is still open, but it won't be forever.
So because they're using the liquidity to manage the debt, the rollover years, which tends to be this yellow and the kind of weird peachy color, the summer and fall, those are when the peak debt rollover happens. So they add lots of liquidity. So if you look at that, you can see the liquidity piling into the system as they start rolling those debts over, and they need to print more money because they have to issue new debt to pay the interest on the old debt. Sometimes they use a central bank balance sheet. Other times they just create liquidity, and it's done on a globalized basis. Right now, China's the big liquidity driver. And then you get those blue years, which are the winter years, when they start withdrawing liquidity because they don't need to service the debts because there's no debts around those periods of time. So that's why we get this cycle. And this cycle creates the Bitcoin cycle. It actually corresponds with the presidential election cycle and also the Bitcoin halving cycle. They're all those summer months. The summer months tend to be pretty strong. You can see the previous examples, 2012, 16, 20, all good months, all good seasons or years. And then fall tends to be very strong. The fall in 2021 was still strong, but it had a stunted cycle because liquidity was starting to get withdrawn because they put so much in. But if you look at 2017 and 13, they were gigantic. So the fun is yet to come. When you look at it in year-on-year terms, you can see the cyclicality and how related Bitcoin is to global liquidity and how the seasons dictate that. So what we're looking forward to is the big rises in price ahead. What happens normally is around the Bitcoin halving or around the early part of crypto summer. Now, we're not talking about summer as in actual seasons. We're talking the 4 seasons, which correspond to each year. The early part of the year usually is something called the boring zone. So it starts strong and then sideways corrects after the halving for an extended period of time, and then eventually begins to break out. The breakout usually ushers in the banana zone. So we've had the boring period. It was about 8 months long. It was a nice, orderly correction. So what lies ahead? The banana zone. The fabled favorite yellow fruit of all of us. The one where our hopes and dreams are all in it. Let's talk bananas. So when we look at halvings, from the halving, you can see what happens until the end of that year. So we had 2020 at the top, was very strong. We had another strong year in 2016, and 2024, we're a bit below par right now. But don't worry about that, because you'll see it in context of everything else. We should still see extremely strong price rises. The US election, well, that's a key time for this, because after the election, we get the banana zone. There's often liquidity being injected into the system, and there's also a shared sense of optimism that drives prices higher. We are just starting that now. At the time of recording, the election was 2 days ago, and already crypto prices have started their explosion into the banana zone. Bollinger Bands are a measure of volatility or lack of volatility, because Bitcoin was ultra low volatility recently. And that's really interesting, because every time you get there, when you get these kind of low volatilities, you tend to get large price rises. And we've been following that kind of price action. So you tend to get 200, 300, 400% rises over the course of 6 to 12 months. So that, I think, is another interesting signal. So suppressed volatility usually leads to hyper volatility. Also, Solana exhibiting extremely low volatility. That box in the right, it shows you that every time we've got to these levels, we've seen everything from a 25% rise to a 520% rise in 2 to 3 months. This is bananas.
Raoul Pal has sparked serious attention with a striking claim. 89% of Bitcoin's price movement over the past 2 years directly mirrors shifts in global liquidity and money supply expansion. His data-driven chart reveals a near-perfect correlation between Bitcoin's rally, particularly since it broke above $40,000 in 2023, and the trillions of dollars injected into the financial system. For Pal, this connection cuts through the noise of media hype, speculation, and volatile headlines, exposing Bitcoin's deeper narrative. It's not just a tech asset, but a direct response to the debasement of fiat currency, especially the US dollar. Yet even in this liquidity-fueled environment, external shocks still matter. Last Friday, Bitcoin plunged over 4%, falling from above $18,000 to nearly $13,000, following heightened tensions in the Middle East, briefly bouncing before retreating again. These sudden swings highlight the ongoing vulnerability of risk assets to geopolitical volatility. Adding another layer to the debate, Anthony Pompliano has introduced a compelling framework: Bitcoin as the new bonds. He argues that when seen as a fixed supply deflationary asset, Similar to US Treasuries, Bitcoin's role in the global financial system begins to make more sense. With growing chatter about US Treasury bonds potentially being backed by Bitcoin and a strategic government reserve already holding nearly 200,000 seized coins, the narrative appears to be shifting. Bitcoin is no longer just a speculative bet. It's evolving into a form of serious monetary innovation, challenging the foundations of the traditional finance and hinting at a future where digital scarcity plays a central role in sovereign strategy.